This is the Daily Market Comment by Marios Hadjikyriacos. I'm Maria Pachurdiz. Thanks for joining us at XM.com. Japanese authorities most likely conducted another operation in the currency market, deploying their vast firepower of FX reserves to shore up the sinking yen. Like a bolt out of the blue, the yen stormed higher last week and then again on Monday, with the moves being so sharp that intervention was inevitably behind them. The plot twist is that once again, intervention was unsuccessful, as dollar-yen has already recovered most of its losses. On Friday, the spotlight will turn to the Bank of Japan meeting. Although inflation has fired up and is running at 3%, wage growth and inflation expectations remain muted, reinforcing the view that there isn't much domestic inflation. Coupled with the Bank of Japan's decision to defend its yield ceiling last week, a policy shift seems unlikely, keeping the yen hostage to any moves in foreign yields, and the picture gloomy overall. In the UK, politics is front and center after former Prime Minister Boris Johnson dropped out of the Conservative leadership race, leaving his former Chancellor Rishi Sunak as the frontrunner to become the country's next leader. The prospect of a Sunak government came as music to the ears of the British pound, which opened the week with a gap higher on hopes that fiscal discipline will return to number 10. Sunak could be confirmed as Prime Minister as early as today, allowing sterling to put the entire budget debacle behind it. Staying in Europe, the latest business surveys highlighted recession risks. Companies are turning defensive as demand is falling sharply, putting the Eurozone economy on a contractionary trajectory. On the bright side, European gas prices have declined dramatically lately, so any recession won't be as deep as investors initially feared. This allows scope for a relief move in the euro, in case the ECB sounds a hawkish note on Thursday. Another round of speculation around a Fed pivot injected some life back into U.S. stock markets on Friday. Wall Street ripped higher by almost 2.4% after media reports suggested the Fed might slow down the pace of rate increases in December. Overall, the risk-reward profile for equities remains unfavorable. Real U.S. yields have gone through the roof lately, which will eventually drain the oxygen from riskier assets as capital flows back into risk-free investments. Finally, in China, stock markets fell sharply on Monday after Xi Jinping tightened his grip on power. Xi appointed some of his most loyal allies in leadership positions, fueling worries that the economic, regulatory, and geopolitical trends that have alarmed investors will persist. This was today's Daily Market Comment. Thanks for joining us at XM.com.